Wow, coming off that, how are you guys? Welcome live at 5 Wednesday, live with Jeb Smith, myself, and Josh Lewis, my lender. We're both located here in Southern California. We're here to answer you. Wow, let's start over. Hi, I'm Jeb. That's Josh. We're here to answer your mortgage and real estate related questions. So put them in the comments below. We appreciate you guys being here. We talk about everything from what's going on trending within, with regards to real estate, what's happening in the interest rate mortgage world. Josh, welcome to the show. We've already got some presumptuous people in here. They're already asking you questions before we went live. So they think you're going to be on the show, which means I might need to change things up here really soon.
We'll see. We'll see how it goes. There's hey, at least one of those guys isn't tongue-tied, so we'll ask him questions.
Fair enough. So the sun is setting, guys. So this is what happens at 5 o'clock when you don't have blinds. The sun shines directly into your window.
One more week and you'll have blinds, bro.
Hey, we'll see. We'll see. I've been promised blinds for 6 weeks. But anyway, we appreciate you guys being here. Not a lot happening in the real estate mortgage world, but there's a lot with regards to everybody starting to put out their home price forecasts, which you guys have seen me talk about. So, everybody that was predicting the 2021 housing crash, I think will now have to start titling their videos for 2022, because I don't think that's going to happen in 2021 at this point. So, they'll have something to film here soon enough.
They get to just make the same video and just put a new number at the end of it and pretend like they didn't say it last year. If you, what is it? Even a broke clock tells time correct two times a day. Tells the you've got me tongue tied now. Tells the correct time twice a day.
Yeah, I believe it's said in simpler terms, but essentially we've
Something
got
like
what you're
that.
saying. Yeah, a broke clock is right twice a day.
There you go.
So there you go. Yeah, no, absolutely. And eventually, at some point in the future, there may, they may be right, but I don't think that's coming anytime soon. But we do have some questions here to start it off. So if you guys have questions, put them in the comments below. We'll do our best to get to them. Keep in mind as it starts to get a little bit busier here, more questions come in. Occasionally we miss things, but we have someone moderating for us. She'll help us if we did miss something. That's Jennifer. Thank you for being here, Jennifer. And no need to continue to post them. If you continue to post them, we kind of have the tendency to ignore them. So just keep that in mind. So anyway, let's start. Josh, the first question's a good one. Evelyn Vega said she's planning to buy a home, pay my monthly mortgage with my pension check. What do you think? I have the money to put 20% of the $360,000. So she's buying a $360,000 house, putting $72,000 down. It sounds like she's pulling money from a pension fund or some other source of funds. Thoughts on doing that?
At least once a month, whether it's a purchase or a refi, we're helping a retiree with a loan, and they're using pension income or retirement income. I have a client right now. It's a mother and son buying together. Son is employed, mother has her pension and Social Security. So it's just another source of income. So if it's enough to enable you to qualify for the loan within the guidelines of the qualifying ratios, then you're good. So really, it's no different than anything else. So if your pension is enough to safely make the monthly payment, just like someone else's work income from going to a job every day, no problems with that whatsoever.
Awesome. And one thing I forgot to mention at the beginning of this video, I want to keep you guys up to date on inventory here locally. For those of you who've been following, me specifically every Wednesday, and I've talked about this for the last, I don't know, 7 or 8 weeks at least. We've been tracking inventory here in Orange County and Huntington Beach, where I'm located. And the reason I bring this up is because, regardless of where you are in the country, you might not have the exact same thing happening, but when people say there's more inventory on the market, buyer demand is slowing, what I'm going to tell you right now is exactly opposite of that, and the numbers to back it up. So, over the last couple of weeks, 4 or 5 weeks ago, we were at about 2,700 properties here in Orange County. And we came from the lows in the spring, which was around that 2,000 number. And that's active homes on the market. So 2,000 active homes on the market. We got up to upwards of about 2,600. So that was about a 25% increase in the number of available properties. And we saw something similar here in Huntington Beach, where we went from around 120 active properties to about 170. I think it was 177 was the highest number I saw. As of today, we're under 2,000 for Orange County, 1973 as I came on the show. So 1,973 properties for all of Orange County, 3.3 million people. So there's not a lot of available property. That's including luxury properties. That includes senior properties. That includes condos, townhomes, everything. So 2,000, less than 2,000. So, we've that 25% we added is now gone, right? So we really haven't seen much of a change from those spring numbers with regards to inventory at the moment. Now we've seen property come on, but it's met with buyer demand. So it's being met with buyers out there. It's not like no new homes have come on the market. There are homes coming. They're just getting taken by buyer demand. And here in Huntington Beach, today we're at 122 active homes. So we went from 170 down to 122. I don't know what that math is, but 30 something percent, if I'm doing it off the top of my head. So for those of you out there looking, just keep that in mind when you're out there looking. When you're starting to see it get a little bit more competitive again, or that you've heard things have slowed down, what I can tell you as a real estate agent is I did see a slowdown for about 4 or 5 weeks. And when I mean a slowdown, I'm not talking, no offers or in fact, I did have no offers on a couple of my properties for a little bit, but they ended up going in escrow above the asking, even on the ones that sat on the market. So, but now what I'm seeing the last couple of days, been putting in offers, had a client see, 6 properties in the last 2 days. Every single one of those properties has multiple offers on it. And she just saw 3 of them last night, and all 3 have multiple offers on them above the asking price. So just an update of what's happening there. And Josh, you can,
again, that's anecdotal. It's the people that Jeb's working with, the people that I'm working with. I couldn't tell you when the last time was that I saw a client that had just wrote an offer, only offer considered, boom, yours is accepted. It's a multiple offer situation for every client. So it's anecdotal for us. For Jeb, it's only in the Orange County area. For me, it's only in California. So could it be different in North Dakota or in Florida?
Yep.
Absolutely. And it can be different even in different markets in there. But I talk to people in all parts of country of the state of California. So whether it's Sacramento, whether it's the Bay Area, which we all know, unless you started getting into rural Northern California, those people are a little bit different. But we have 2 buyers in Fresno right now,
We're not
multiple
talking
offers.
about we're not talking about the people are different, bro. We're talking about the housing market.
Yeah, well, they're different too. I mean, if you're in Northern Cali, you get 4 hours north of San Francisco, you're not a Californian anymore. You're like a frontiersman.
Oh boy, we just lost them as viewers. They just checked out.
All of them, all
Yeah.
3.
Yeah, all of them. So anyway, so real estate's local. Just keep that in mind. Don't take what I'm saying to your market. Just keep it in mind when you're out there looking. That's all I say.
So Jeb, hold on.
Yep.
The thing that I would throw on what you just said is 100% correct. And let's pile on what Jeb and I always say. You need to work with an expert, and on the real estate side, and definitely better on the mortgage side also, but specifically on the real estate side, an expert in your area, someone that can tell you the stats in your area, just like Jeb can tell you. So the big reason, it's not so much that, hey, you have to get with someone that sold 100 homes last year, but if your neighbor has a license and they're semi-retired and they sold 1 home last year, there's no way they have that knowledge. They have to be active in the market, working with buyers and sellers every day to know those stats in your market. We're lucky. We're in California. Jeb references a similar report in the Arizona market. Bigger markets, there's good data that you can access and buy. Other markets, you have to dig into the MLS and pull it out and massage it yourself. So it's important that you work with someone that knows and likes numbers and knows the market that way, because it's super essential to have that type of insight in your specific market that you're looking in.
And the last thing we'll say about this and we'll move on is sometimes you have to read between the lines on some of that data too, right? Don't just take the numbers at face value. Sometimes the numbers can be deceiving based on other things that are happening in that environment, in that market for whatever reason, right? Just because the number of homes selling goes down doesn't necessarily mean that buyer demand is going down as well. It just means, or it might be going down, but you got to understand that why are there less sales? Is there just less property to choose from? Is there just less available inventory in a certain market? So, all of that stuff matters. And I think what people do is they take the numbers, the headline, and they run with it. And it's a scare tactic for a lot of people, which sucks because there's a lot of people that probably could have purchased back in February of last year, or even the previous year, that set because they watched something or they read something and it scared the hell out of them. And then now here we are, however many months later, and we're 25% higher in value than we were then. So, and not to say that that's going to continue, but it's just keep in mind, just make sure whoever your source is knows what they're talking about. All right, so we're going to move along. Jennifer has a question here, said, are we safe in HB? And then she goes up to follow it, talking about the oil spill. So we had an oil spill here a couple weeks ago, and closed all the beaches. And the reason I even bring this up is because what you said here is interesting, because I actually had a reporter reach out to me from a local newspaper, and her question, she left me a voicemail, and her voicemail was, I wanted to see if I could get a quote from you on how the oil spill has affected your business over the last couple of days. And I laughed because I'm like, what the hell is she talking about? I mean, the market, nothing has changed. And what she did is she saw there was a tweet somewhere online about how the real estate market was affected here in Huntington Beach because of the oil spill. And at the end of the day, it was garbage because nothing was really affected. I mean, obviously the beaches were affected and some of the marshland and wildlife and that sort of thing. But since then, it's been cleaned up. The beaches are back open. Things are, I wouldn't say normal, but they're 95% of where they were. So it was probably portrayed a lot worse than it was. And I think they thought it was a lot worse than it actually was. Things seem to be moving in the right direction. All right. So let's see here. Here's a question, Josh. We talk about inflation quite often. You follow a guy that sends out a weekly newsletter, discusses inflation quite often. I read it as well. He talks about this question. every week almost. So do you think inflation is transitory? Are we still talking transitory inflation, Josh?
So at the beginning of the year, I think all of us felt pretty strongly that that was the case. That transitory, we thought it would be end of the year, into the first part of 2022, and it's looking like it's going to linger a little bit longer. Now, does that mean we're changing the view and saying, hey, I think this is long term and we're looking at stagflation or really long term persistent higher inflation? I don't. And the reason for that is this is supply side inflation. We're having a hard time getting the goods to market, and eventually that's going to get solved. It's taking longer than we're thinking or originally thought, but it's going to happen. We saw today the Port of Los Angeles came up with the same information or the same decision that the Port of Long Beach did, that they're going to be working 24 hours a day, 24 hours a day, 7 days a week to get those ships unloaded. Now, the next bottleneck is we don't have enough truckers. So when those big shipping containers come off the ship, they go onto a truck and someone has to drive that thing away. And those are just two examples. There's a lot of examples of things worldwide. We have issues where governments around the world are fighting and trying to limit fossil fuels. So fuel costs are up. So that whole battle, if you're an environmentalist, high fuel prices is a feature, not a bug. They want that to be the case, and fuel is an input to so many things in the supply chain that can create a higher level of inflation. We also have employers are having a hard time getting people coming back to work. So you've all seen, I'm sure in your areas, it's no different. You go to a fast food restaurant, occasionally they used to have a help wanted sign out. Now they have a giant banner that says help needed, starting at $17 an hour. So that minimum wage issue is sort of taking care of itself. But again, is teenagers or fast food workers making $17 an hour instead of $11 an hour going to lead to some massive demand driven inflation? I don't think so. If you look at consumer spending since the Great Recession in 2008, has been decreasing. So it's a more conservative public. So when you look at that, I don't think this is going to last long term. When the supply chain issues take care of themselves, we should be good. At a certain point, we're going to have a real recession. So we would still be in the longest expansion on record in the United States if it were not for that tiny little 6-week recession we had last year that was purely driven by COVID. The fundamentals would mean that we had this long expansion. It's a weak expansion, but a very long expansion. It's going to come to an end at some point, and we're going to have a recession, which will decrease consumption and we'll eliminate and take care of some of that. But long answer to a fairly short question, transitory, yes. Transitory a little longer than we thought. I mean, it wouldn't, at this point, I don't expect that it's going to run all the way through 22 into 23, but it sure could. And some of the things that you need to take into account, the measures for inflation are year over year. So once you get to a higher level, they have to increase again by that much year over year for inflation to stay at that level. And I don't expect that to happen. So we can actually see next month CPI is likely to be higher than what we saw yesterday. I think we were 5.4% yesterday, and they were expecting 5.3. It's going to accelerate the next couple of months because look back 12 months and the CPI figures for November, October and November of last year were really low. So they're going to replace a super low number with a higher number. Right. So don't freak out when that happens. We know it's coming. You can see it coming. We do have a crystal ball in this instance. It doesn't tell us much, but the same thing's going to happen next year. So we'll see where we're at.
So with that said, though, Josh, so inflation is when things the prices continue to rise over and over again, right? It's not a one-time rise in price. It's when the prices of things continue to go up, right? So the prices of cars go up, and then they go up again, and they continue to go up and up and up, right? So if they go up once, that's not necessarily inflation. So my question is to you, Josh, is, do you think now that we've seen the price of some of these things go up, we've seen the price of cars go up, we've seen the prices of furniture or fuel or whatever it is go up, when the bottleneck works itself out, do you see home builders reducing prices? Do you see these car manufacturers starting to reduce prices again, or do you think they stay where they are?
Some things, the prices are going to be sticky to the upside. Like you mentioned, right. Cars, I think, unfortunately, they were already at the highest levels ever as a percentage of median income that it takes to buy an automobile. But if you look, the car sellers have had record low volume, or not record of all time, but very low volume relative to 2019, but their profits are at record levels. So they're seeing that if we make fewer, more expensive cars, we can still hit our profit levels and be just fine. So some of those things I think are going to stay to the high side. In terms of a house and even truly a car, everything comes back to supply and demand. So all of these things, manufacturers have a hard time getting supply to market. Some things demand is higher than normal, but most things demand hasn't changed at all. The demand side inflation is more persistent and troublesome, because if we have everyone wanting more of everything, that doesn't go away year over year. They just, I want more, I want more, I want more. So at some point, supply is going to correct itself in industries that are more insulated from competition, or we have a finite supply permanently of things. Those prices could be stickier to the upside. So I think we're going to look back and we'll see sort of a price correction, and we'll long for the great days of 2019 when everything was a little bit cheaper. But in terms of persistent year over year inflation, I don't think we're going to be looking at that.
No, no. I mean, I agree with you too. The only reason I even brought up the car thing is because I was talking to someone else about that, and he brought up a good point. He's like, these car dealers, these manufacturers of cars, they measure market share, right, based on the number of cars they sell, not necessarily the profit margin on them. So in order to be the leader, if you will, with regards to being the biggest car manufacturer, or whatever their statistic is, they need to sell more cars. So in some cases, the argument was maybe you do see some price improvements on those cars just so they can sell more of them, even though the profit margin might not be as high. Therefore, they maintain whatever that is. And I don't even really understand why you need to be the market leader if you got the biggest, if you're making more money than the next guy. But I guess,
Well,
from a
Jeb,
marketing perspective, I guess it helps.
along that train of thought, we've talked about this before. If home builders can only build X number of homes due to lack of land that they have, lack of labor to put those homes up, do they go and put up $200,000 entry level homes?
No.
They go and they build as expensive a home as the market will absorb. So that's how they're maximizing profit in a supply constrained market. Now, when we get back to more normalcy, you know how this goes. It's sort of like OPEC, oil producing and exporting countries. They all want to control prices and keep them high. So they say, well, let's cut production, and then that will get prices up. As soon as prices go up, they all start cheating and producing
Yep.
more because they want to get more of that, and it pushes prices back down. It's the same thing. That's the beauty of a market economy. Right now, they hold the cards and they're making the decisions, and it leads to higher prices for all of us. In the long run, once profits recede, they'll get greedy and they'll start trying to chase profits any way they can, including lowering margins.
No, good stuff. All right. Got a question from Jen. Jen's asking, how soon should you lock in after getting your offer accepted? Josh, what do you recommend to people out there in this environment?
It's a different version of a question that was asked last week. So for the most part, 90% of escrows, or Jeb, would you say 90% of escrows are 30 to 45 days?
I would actually, in this environment, I would actually say shorter than that. I would say from anywhere from 21 to probably 30 days.
Okay.
I haven't
If you
seen many
have
45 lately.
if you have a 30-day or less escrow, you have enough things to stress out. Is my appraisal going to come in? Is my inspection going to show gnarly stuff? How is the seller going to react to me saying I want these repairs on the inspection report? There's very little likelihood of rates moving appreciably lower in a 30-day escrow or even a 45-day escrow. So I know there are lenders out there that dangle this carrot and say, hey, we're going to watch. I'm going to watch the market every day and we're going to write it down. If we can get within 15 days, you're going to save an eighth of a point or a quarter of a point. Well, when rates go down, they go down very slowly. Like when I pull up the boring candlestick charts for you guys, when you see the rise of the candlesticks going up, which is lower rates, it's this long, slow slog. And so these little green candles, and when it goes bad, you see these giant red candles.
Right.
So once you're within 30 days, you got enough stuff to stress about unless you truly look at yourself in the mirror and say, I'm a gambler. I like going to Vegas. I like sitting at the blackjack table.
Right.
Lock it, move on, and take it off the table. The people that have a tougher decision to make, you just got under contract on new construction and it's going to be ready in February. What do we decide? You can do a 180-day lock. It's really expensive. You're probably going to pay an upfront fee, and you're going to have a much worse rate. So from that perspective, it's more difficult, and you need to talk to your loan officer, and hopefully you're able to discern whether they have any clue what's happening in the bond markets and what's likely to be the case. A client of mine right now, if they got into a new construction, I'd say we probably just want to let it ride. I don't think there's any reason for rates to be appreciably higher, which would mean we should lock it. But in answer to this, I think we're probably talking about your standard, 21 to 30 day escrow, maybe 45 days. Lock it and take that risk off the table. You have enough stuff to stress about, and it's unlikely to move, especially in the current market. I mean, I think we've probably kind of hit the worst levels, and we're going to move sideways here or slightly improve. Even at that, I would say lock it, take it off the table. Let's get the thing approved. Let's get the appraisal in. You finish your inspections and get this thing done.
No, absolutely. And I was actually going to ask you, I was going to bring the question up. Well, if I was your buyer, what would you recommend right now? So you answered it. And once you lock it, guys, move on. Stop looking at rates every day. All right. That same thing. Like once you buy a house, stop watching the price every day. Just move on, pay your mortgage, and enjoy it.
I thought you were going to say, once you get married, stop looking around. Don't look at the other ladies. Just keep your eye on the prize.
Listen, that you could go that route. That is good advice as well. Let's see here. Al Bundy. Al. Good old Al. Al, are you seeing purchase mortgage apps increasing?
No, definitely still strong. Like, it's funny. I'm not a pessimist. I'm actually an optimist in the real world, but like Jeb will tell you, I have real wide field of vision, so I can look for problems everywhere. So I'm always looking, what could go wrong? Where is this not going to work out? And every week we come in, and it's been pretty consistent. So haven't seen any slowdown or drop off. Haven't seen any big acceleration either. What we will see is once you get to about Thanksgiving, our business is solid through the end of the year. What's generally slow is January, because people lose interest in dealing with stuff like mortgages from the Thanksgiving holiday through New Year's Eve, and really almost till the Super Bowl. I don't know what you see, Jeb, but for us, that's generally the seasonality where we see people kind of go real quiet.
So what you're saying, I'm just going to read between the lines. When they post in December, the mortgage applications are down. That doesn't necessarily mean the market's tanking.
Hopefully they're giving you a seasonally adjusted number, and not going, hey, from August applications are down 22%.
No, but that's what will happen. I'm telling you right now, and I'm going to post it in there when it does. Yeah. All right. So Miguel's got a good question. What are you guys hearing from borrowers that exited forbearance? Did they modify or defer? So I think I've actually had a conversation with a borrower or two who has contemplated selling their property. Some people have reached out for advice on exiting forbearance. I can tell you that the couple people that I've spoken with have been offered reasonable and fair terms from their lender with regards to the exit. Some of them are considering selling just because of life situations, that sort of thing. Outside of that, I haven't really heard much. Josh, I'm sure you're probably dealing with some people looking to refinance to some extent, right?
Absolutely. We're doing a refinance or two per month of people. The key thing for most loan types, you have to have made 3 on-time payments. Most people didn't just set the money aside and they go, boom, I'm going to pay it current and then refinance. So for the refinances, people are contacting us. They make their 3 on-time payments and can refinance out of it. My business partner and I put up a separate website called the Forbearance Report when this first broke out, because we knew there would be people with a lot of questions. And the comments we get on that, they're the exception rather than the rule. At least anecdotally, the people that I talk to on a daily basis are getting decent, like Jeb said, decent offers from their current lenders, things that are reasonable. We talked about a certain online lender last week that loves to take advantage of veterans while telling them how they're the #1 lender helping veterans. Well, we have a veteran that did forbearance for about 15 months, and now they are telling them that their payment is going to be $8,000 a month for the next 12 months to get caught up, and they have no other option but to do that. and they're telling them that no, they're not eligible for a VA IRRRL, despite the fact that VA is the easiest and most lenient. You don't have to make any payments. As soon as you end the forbearance, VA will allow you to bring it current with that loan. So there are lenders out there that are giving people misinformation and not working with them under the clearest of guidelines. So hopefully those folks contact us so we can either help them or connect them with someone that can. But for the most part, I think realtors would be the ones that would be getting more connected with getting questions from people looking to sell. I think there's going to be some sales, but it's generally the minority. I saw the headline yesterday. I didn't get to see the article and get the details of it, but I don't know if you saw it or read it, Jeb, but yesterday, record numbers exiting forbearance over the last 7 days. So for the most part, it's resolving the way we expected, fairly orderly. Most people staying in their homes, starting up payments on their loan, whether it's a modification, a refinance, or a lump sum repayment. And some people are going to have to sell, but they're definitely the minority.
No, agreed. Yeah, I don't really have any additional information outside of that. Al goes and says that Jason Walter, fellow YouTuber on YouTube, right? Makes sense. Did a video on it and can talk more about it. I haven't done a video on it. I kind of stopped talking about forbearance to some extent just because we moved past it, and honestly, Josh nailed it. It's happening exactly as we said it would a year ago, a year and a half ago, when this whole thing started happening. And so I don't really think there's a big conversation to be had about it, to be completely honest. With that said, if you do have, if you're in forbearance and you're getting ready to exit, or you've exited and they're not working with you, reach out to somebody, because like you said, VA has options. Like VA, has come out with their own options, right? Initially, forbearance has always been a part of something that VA's had, kind of in the background if you needed it and whatever. It wasn't, necessarily maybe what they're offering at the moment, but there was always the option. Now there is a plan, a waterfall type option plan with regards to VA too. So just, make sure you're talking to somebody that actually has the knowledge and can guide you in the right direction. Let's see. Mike has a question. When refinancing out of an FHA, going to conventional with cash out, how long do I have to wait before consider buying an investment property, house hacking? So I'm getting out of my FHA loan. I'm going into conventional. I'm going to pull some cash out. How quickly can I buy that investment property?
This is a super popular question. I bet you every other week we get some version of this, and it doesn't vary by loan type. The difference with FHA is in this instance, it doesn't matter. With FHA, it's always owner occupied, but he's talking about going from FHA to conventional and getting some cash out. So it's a conventional loan. There's nothing that says I am staying in this home for 6 months, 12 months, 24 months. What you are stating is that within 60 days of closing the loan, you intend to occupy the home as your primary residence.
No, they're going to buy an investment property after pulling that cash out. So they're going to. It sounds like they're staying in that one and buying an investment.
If you're going to stay in it, you could do them concurrently. We've literally had people where they get their property in escrow and they don't want to do their refinance 1 minute before, and pay interest on the additional cash out before they're ready to close, where we're just processing the refinance, close it, and then we have the closing statement that's sourced in seasoned funds, and it wires directly over to the purchase escrow. So for that purpose, if you're going to stay in that property, zero waiting period whatsoever.
Got it. All right. Meta Legata.
I think you got it right, but I think the most important thing is what is in her hand. Is she a guitar player, or is that like a cobra?
I think it's a guitar. It looks like it's a banjo.
Oh.
I'm kidding. I have no idea. Is purchasing a $376,000 condo a good investment move for a first-time home buyer if I plan to live there for 4 years and possibly move overseas and either rent it out and have it appreciate or sell? Josh, thoughts on buying? I mean, this question, there's a lot of pieces here, but what are your thoughts on buying something now with the idea that you're only going to be there for 4 years and you plan to either keep it or sell it? It's not a loaded question, but it could go a lot of different ways.
Well, generally, well, you and I have answered this question a million times, and the answer is I'd like to have at least a 5-year window on it. Over 5 years, you should see enough appreciation to at least sell without taking a loss. In the current market, we think we're going to see strong appreciation in the next year, probably the year after that. So when you look at principal pay down over that 4-year time frame, the likelihood of additional appreciation, I don't know if you're going to show the numbers, but Jeb, you have the economists analysis of a group of economists, 300 economists expecting about 11% average appreciation over the next 5 years. So from that situation, you should be fine.
Yeah, averaging 31.8% over a 5-year period. Yeah,
So
which
30,
I did a video on yesterday. Yeah.
So it's a good video, and listen, economists aren't always right, but with the best available information, that's a pretty reasonable guess of where you'd be at. So maybe it's only 25% over 4 years, but in that 4-year time frame, you're going to have paid that 376 down to about 330. If it goes up 25%, it's 450, 480. So you're going to be sitting on a nice amount of equity. What I always want to think of in this situation and plan for is, what's the worst case scenario? What's the worst thing that we think could happen through this time frame, and are you comfortable with it? I can't foresee any way that the values decrease, but what if they did? What if they went up 5% next year and then started a slide and dropped 10%? So you're 5% below where you are right now. At 4 years, do you still feel like you'd be likely to be able to go overseas and rent the property out and break even? If so, it could still make sense. I just always like to think, what's the most likely case? I don't hardly ever think in terms of best case. What's the most likely case and what's the worst case? And then am I comfortable with both of those outcomes?
No, I agree. I mean, the things you have to think about with a condo is HOA dues, that sort of thing. You got to factor all that in, right? When in your total monthly payment, how much can you rent it for? Because chances are, if you have the same payment you do right now in 4 years, the cost associated with that property, being outside of California, you're probably going to have higher property taxes. You're probably going to have a higher HOA dues. So, you know, if rates don't go down and you're not in a position to refinance, are you in a position to have positive cash flow where your monthly payment is now versus where the rent is? Because rents are also going to increase. So there's a lot of moving pieces here. But if you were going to be upside down $400 or $500 a month at the present time renting it out, then it's something you need to consider, right? I mean, there's again, we don't know where the market's going. I personally think home prices are going to continue to go up, but at what rate, right? I mean, I said 4 to 5% next year was my guess. California Association of Realtors came out and they said 5.2% as of a couple of days ago. But then you've got, like Goldman Sachs saying 16%. But where is that, right? 16% in Phoenix, 16% in Boise. Like, where are we talking 16%? Because I don't think the median home price is going to increase by 16%. But what do I know? I wouldn't have predicted 20% this year either. So it's all relative, and there's a lot of moving pieces there.
And Jeb, as much as we like to bash on Zillow and Redfin, there are things to bash them for, and there's things to congratulate them on. They collect a shit ton of data, and it's generally accurate data. So,
right.
Like if I'm going to look at CAR versus Zillow's economic analysis, I'd probably lean more towards Zillow being more accurate than a trade group. Zillow has better data, and they probably have better economists. They're a large for-profit corporation that's made a ton of money. I'll bet you they have a bigger and better team of economists than the California Association of Realtors. And with that, if you follow a property or a zip code every month, they'll give you an update. So for my zip code, they're predicting 11.6% for the next 12 months.
Well,
that's
actually
high.
Well, they actually came out with their report for 2022 as of I think yesterday, or it might have posted this morning, in fact, which I talk about in a video that's going to be posted tomorrow. But they're expecting 11.7% increase. So 11.7 from Zillow, 16% from Goldman Sachs, 5% from the California Association of Realtors. What I can tell you is that none of them are saying decline, right? So regardless of who is right or who is wrong or who is high or low, the bottom line is none of them are going the other direction, which I think is probably the most important piece
Even
there.
the biggest bears on the planet, CoreLogic, who said last year 6.6 decrease because of the pandemic was coming.
Yeah, they're at 2%.
2.2. So even
Yeah.
they, I think that home values are going to go up.
Yeah, they were only wrong by like 30%. So,
That's all.
Exactly. But anyway, Mike, appreciate the super chat there. Josh answered your question. I keep your money. It works out for everyone. Thank you.
It works great for Jeb.
Let's see here. Ishmael says he finally got into a home. So congrats, Ishmael, to you. Les and Heidi are basically talking about no crash. Goldman Sachs predicting all that good stuff. We've talked about that. Let's see here. Oh God, you people, you crash people crack me up. I'm gonna do one where I just put them up here and I don't know, make fun of you the whole time. I don't know, but I'm not gonna. It's so ridiculous.
It's not hard to tell who the renters are in the right column.
The people that missed an opportunity. It cracks me up. The people that don't own homes or the people that have been talking for the last 3 years about a market decline are the most pissed off people in the world and think that the crash is coming. So, hey guys, it's you got a couple more years of waiting. Anyway. All right.
Again, the stopped clock will be correct eventually. So if you just predict and come up with a new reason every year, So again, some of these are just silly and crazy.
I think this is what the fact that Joey Crack has put in an offer on a property is worth talking about. I mean, regardless, there's not even really much of a question here to answer. I mean, there is kind of, but hey, congrats, Joey, on it. I mean, whether it gets accepted or not, this is a milestone. Congrats. But no, what I would say is you're going to hire an inspector to do an inspection on a property. I have this conversation every time with a buyer. The inspector is hired to find problems, right? You're paying that person to find problems. It doesn't matter if it's, existing construction that's 50 years old, 100 years old, or new construction, built in the last couple of years. There's going to be things that have changed code-wise or cosmetic changes or just things that don't work for whatever reason. So things to walk away with, I mean, for me, are big ticket items, but I wouldn't walk away from anything without asking somebody to fix them unless it's something like, a huge crack in the foundation or the slab or that something that really can't be repaired, then you walk away. But, HVAC issues, roofs, water heaters, appliances, bigger ticket items, costly items are the things that you need to focus on, right? Because those are the things that typically have, when you're coming to your house, have some sort of lifespan on them. And at some point will need to be replaced. And so, those are the things to pay attention to, in my opinion. So keep, but that doesn't mean you need to walk away from them. It's up for negotiation and you have to decide what you're okay with and what you're not. But cosmetic things, like small plumbing, electrical, that sort of thing, to me, is not really that big of a concern. Now, I grew up, father was a contractor. I was around it my entire life. And so, most of that stuff is a relatively simple fix for anybody that's remotely handy. Now, you get into stuff that, where you can't watch YouTube and do it, and you got to hire somebody, start thinking about what it costs to do those things. Then maybe that's something for you to walk away with or walk away from. But if you're talking, I see people haggling over small ticket items and backing out of escrow for it. And yet homes are appreciating at 3 to 4% a month over a period of time. And so, okay, you just haggled over $1,000, but the next house you're paying for just went up 15,000 or whatever the number is. So just keep all that in mind when you're making that decision.
I would say, Joey, stay away from indoor pools and spas and saunas. Those are the biggest features that I avoid. And I am joking, but they are out there. I've seen plenty of houses with all of the above, and they're always gross and abandoned. So I guess if you can tear it out, feel free to do it. But I've seen all of them, and none of them are good.
No, absolutely. And you talk about heating oil and electric stoves and all this in a different question. buddy. We don't have that here in SoCal.
We're the wrong ones to ask.
Yeah, we
Although
don't.
Jeb did have a space heater on his desk, cranking his office up to about 80 degrees today for some unknown reason.
And meanwhile, guys, it was about, you guys are probably going to laugh. It's probably 65 outside. It was windy. It was chilly in here, man. I have a space heater. It was cozy. It's cozy feeling in here. Let's see here. Let's see. I'm trying to find a question. Al Bundy said he saw a Panda Express offering $21 an hour. Holy cow. Oh, boy.
Hopefully that was for the guys cooking the food, not just the people scooping it up into your little plastic tray. Although that stuff will kill you, it is delicious. So I understand the need to keep those people employed.
All right. No, I have no idea where to go with that one. Saw a house bought by Redfin, put back on the market for the price they bought it for. Why did they do that? Also saw another house just sold and now for rent. Roseville, California. So that let's address the second part first. Saw a house sold and now for rent. Nothing crazy there. There's a lot of people buying property, investors buying property. There's going to be a huge push for rentals over the next couple of years as affordability becomes more of an issue. People are going to have to rent, and so investors see it. They see inflation coming to some extent. It's a fixed asset, brings a fixed return. They don't have to worry about equities, where the stock market goes. They're going to gain some appreciation. There's a lot of things there for people buying property and renting it out. So that's no concern. I mean, I see it happen. In fact, I have clients that do that sort of thing as well. Now, the first question, saw Redfin bought a house, put it back on the market for the same price they bought it for. What you have to understand here in some of these cases is that, companies like the Redfins, the Open Doors, the Zillows, any of the iBuyers, these are internet buyers. These are people that buy property online. You type in your address, they send you an offer, they send out somebody to review your house. It meets their qualifications. They write you a check, whatever. There's a lot of fees built into this, right? So typically these companies are still charging what would be a full commission to buy that property. So they're still getting a full commission, which means a listing commission and a buyer side commission on some of these properties to buy that house. Plus you're using their escrow company, their title company, which they're making money off of. Plus a lot of times they have these additional fees that are built in there. You can go to their websites and check them and you can see the full breakdown. It's many cases, it's not less expensive to sell your house to these people, but in some cases they're actually paying more for your house than it's worth. So I can see why people are doing it. But the reason I bring this up is because they have so much built in there in what they made back from that seller. They can sell a property for what they paid for it and still make money because of the costs that were involved on the front end. Now, I can't say that's the case in the one that you've seen, because maybe they just purchased it for too much. They see that they can't sell it for that, and now they're looking to get rid of it for whatever reason. But I would tell you, these are for-profit companies. They're still in business. They're still out there buying property. So my guess is they probably had some built-in fees, and they're able to sell it for that same price for whatever reason. So my thoughts on that. Josh, here's a good question. Do rates change on the weekend?
No, they do not. And the reason why is the only movement, I shouldn't say that, because now basically 24 hours a day, 7 days a week, you have overseas and overnight trading happening. So it doesn't necessarily directly impact the market. What we're watching is 8 a.m. to 4 p.m. bond market trades every day. And that fluctuation is where lenders set their pricing off of. So no, after 4 o'clock Eastern time, or 5 o'clock Eastern time, 2 o'clock our time. So it's actually 4 o'clock in Chicago. Chicago Board of Trade closes, mortgage-backed securities aren't selling. So 2 o'clock market closes. We're not going to see any changes after that until the market opens up the next morning. Do we ever lock on weekends? We absolutely lock on weekends. Let's say it's Friday afternoon and you want to lock your interest rate. I am not going to lock your loan on Friday because 90% of our lenders will let us lock it on Sunday. So I know I can still get that same pricing, but now your 30-day lock is a 32-day lock. So for the most part, it's more along those lines, but we will have a client come in on the weekend or get an offer accepted on the weekend, and we'll lock on a weekend if that's the route they choose to go. But for the most part, we use it for locks late in the week, to just get a couple of extra days on it.
Cool. Bebo. I like that. Kind of like Debo. Debo is no longer with us. Rest in peace. Hi, man. Thank you for the valuable information. I've been putting many offers, and all of them came back with a counteroffer requesting a loan appraisal removal. Is it okay to remove all contingencies? I say no. To the last part, is it okay to remove all contingencies? No. Unless you're a cash buyer, you're completely okay with, you've seen inspection reports, you've done all of that. I would not recommend removing all contingencies. I haven't had a buyer ever, well, not ever. I haven't had a buyer that I can remember in the last 2 years that has removed all contingencies when buying a house, period. Even cash buyers. Now, in some markets, I know crazy people are doing it, whatever. You got to be okay with that. Your realtor has to be okay with that. Now, with regards to the appraisal contingency, that's another thing. I've presented several offers or closed several buyers' properties this year that had no appraisal contingency as a buyer. Fortunately, knock on wood, hear that, guys? We haven't had any appraisal issues. And the reason for that is I go and run the comparables prior to them saying we're not going to do a loan contingency. So we're looking at comparables saying, okay, these properties have closed, escrow have closed at this price. We're presenting an offer at this price. We think it can appraise based on these comparables. And so I feel comfortable telling my client that. So if you're comfortable and you've seen the numbers to support it, then it's up to you. You are in a market. It's starting to trend back towards the contingency removals. I've seen it over the last couple of weeks. Offers we're putting in, people are asking for it. Offers I'm receiving, people are waiving it. Whereas we had a couple of weeks there where we weren't seeing a lot of that, but now we are. So just, I think you've got to be comfortable with it. If you do decide to waive it, understand that if it does come in low, you've got to either be able to make up the difference in that appraised value versus what you offered, or you've got to, because you can't back out of the contract, right? You can't use that as a reason to back out of the contract. So you've got to be able to make up the difference there. So that's what I lost my train of thought. Imagine that. Anyway, here we are. Let's see.
How about this one, Jeb?
All right, let's see it.
Abdul Kareem Kabaj would like to know, I'm a first-time buyer. What should I expect from my realtor/agent? Does it differ? Does it differ for a first-time buyer from a move-up buyer or someone who's owned a home before?
It shouldn't differ. You need somebody that's going to walk you through the process, right? I mean, what I can tell you from real estate agents is that if they're not, this could be a really long-winded question, but most real estate agents haven't purchased a home within the last couple of years. The majority, right? Because there's a lot of real estate agents out there. A lot of them haven't been in the process of purchasing homes in the last couple of years, or aren't really in the education space where they try to educate their buyers on the process. So a lot of realtors go into the process as if you already know the process and the way it's going to roll out without really, providing you any education. And you get a lot of first-time home buyers that have no idea what's going on. So you need to find a real estate agent that's going to guide you through the process, that understands, working with first-time home buyers. It requires a little bit more hand-holding. So what you should expect is you should find somebody that can do that for you, right? That has the expertise, the knowledge, somebody that's experienced out there, especially in this market, and can walk you through that process. Because I think, not all agents are created equal. There's what I can tell you, the downfalls of many, many agents out there is that there's a lack of communication. There's a lack of knowledge, to be completely honest. There's a lack of truly understanding the paperwork, the fundamentals of the market, the process. And so you need to find somebody that actually does transactions, somebody that has the experience, and can walk you through it in a way that you can understand it in really simple terms. And so it's a difficult question to answer because, I don't know what you should I mean, your expectations are, your expectations, but you should, want to find somebody that's going to guide you through that process and hold your hand. So
All of the things that Jeb said are important. I would close sort of with this. In the current market, you need someone aggressive enough to be able to negotiate for you so you don't get on the wrong side of some of these things with the sellers having that leverage, but also cool enough to not piss people off while doing so. And it's a dance. I spoke to a guy this week. He liked his agent. They've been writing offers for 3 months, and he's finally coming to the conclusion that she's probably too nice and not aggressive enough. So there's that balance there that you're always seeking for, and that applies to everyone, not just first time buyers.
yeah, and you need to also find this is something I thought about today, is that, I was involved in another transaction, and things weren't going necessarily as planned, and it's the agent on the other side of that transaction, I feel like, is taking it personal, right? And it's not a personal deal. Like, it's not the agent's deal. It is the buyer and the seller are the two people that are making the decisions. And what you'll find a lot of times is you'll find agents that are, I wouldn't say making decisions on people's behalves, but there's a lack of transparency in some of that stuff that goes on, and they take it personal and let their personal feelings get involved. And I see it often in many different facets of the business. So, that's a whole different level, but just find somebody that has the education, somebody that does business, get a good referral from somebody. And if you need somebody, reach out. There's a link in the description below, and I can refer you to somebody that helps. I mean, I network with top agents all over the country at least once a month, in conversations with people all in different markets and what have you. So with that being said, Josh,
Jeb,
yep.
We've reached a really important milestone here with the show. TFS, the thrifty food scientist, says, how soon can you remove PMI from a conventional loan without refinancing? And the milestone is that Jennifer Lego, our wonderful moderator, has now watched us for so long that she's able to accurately answer most of the questions. We may not be necessary much longer, Jeb.
Well, dude, I think she's plotting a real estate.
She's going to start a real estate and mortgage company and just kill it.
I think. I mean, because she's on our channel. I think she does Kyle, Javier, Jennifer B. Like, she's all over the place. I mean, honestly, she probably knows more than you and I both combined about real estate and mortgage across the country at the moment. So
the answer here is accurate. It will automatically drop off once you get to 78% of the original loan balance. Most people don't want to wait that long. So lenders can require you to have the mortgage insurance for 2 years to demonstrate an acceptable payment history. After that, if the value has gone up enough, you can request an appraisal and request them to remove it.
All right. And we've reached not another milestone, but we've been on here basically an hour, pretty close to it. If you're watching this, you haven't already, hit the like button, the thumbs up, help show support. If you found any value at all, helps more people see it, gets it out there, all that good stuff. And, helps us accomplish our goal of helping buyers and sellers and provide them with useful information to guide them through the process. So thank you for that. All right. So let's see here. I want to put the negative comments up there, but I don't, because it's like, you reward the,
I don't know.
I would say trolls, but I'm going to go with idiots in this case. So I'm not going to do it.
So I don't know if you want to go down this rabbit hole. You can cut this conversation off short, but this is a thought that I have been having here. So there's a question here. It's a question that can't be answered. JD Wrestler, is the American dream achievable anymore? Housing prices are rising faster than the hourly wage. House hacking or taking your chances at cheaper location to have a longer commute or side hustles needed. How are future generation going to be able to become homeowners? And then if Mice and Gods follows up, they won't. The middle class is vanishing. Soon it'll be either rich or poor, no in between. Now, those are opinions, but they're things that I ask here. I look, Jeb, I've done this a little longer than you, but you've done it a long time. So back in the 90s, when I started, I was in Anaheim in central Orange County here, and a single family residence was about $120,000 at that time. And I kid you not, we did a lot of FHA loans with files when they were paper files that looked like a phone book by the time we were done. There's a lot of Hispanic clients in that area, and I would kid you not, 3-bedroom house, we would have 3 husbands and 3 wives, and all of them at that time, minimum wage was like $7.25. They might make $8, $8.50. They worked at the hotels near Anaheim, but 6 of those people, 6 minimum wage people, could buy that house. And this now those homes are $650,000, $700,000 25 years later. So now you look, what's the equivalent, that $750,000 home? Rates are much lower. That payment is semi-reasonable, but for the most part, we need a husband and wife making 6 figures, well into the 6 figures for the most part. So these are valid questions to ask. I can certainly say if I were a younger person just getting started, it would be frustrating. It would be easy to get pessimistic. So some of the questions or some of the comments over here, we make fun of people wishing or wanting for a crash so that they can get in, so they can buy. Like, this is really the reason for that, of why people would wish and hope. And unfortunately, like, one of the things here that would say, you know, talking about having to commute to an area where you don't want, commute from an area where you want to live, or move to a less desirable area. Like, what I will say is, it's logical to people to say not everyone gets to live in Beverly Hills. But unfortunately, when an entire county or coastal area or half of a state becomes Beverly Hills, people don't want to accept that that can happen. We know that there's a finite amount of land and homes in Beverly Hills, and they're all big and nice and expensive, and not everyone gets to afford to live there. We're approaching that point in the coastal communities where there's high paying jobs, there's a lot of people that can qualify, and it definitely is a qualitatively different person that's buying that first time home in Anaheim now than it was in 96 or 97. Whether that's good or bad or indifferent, um, all we can do in the context of this show is answer the questions with the facts that are placed before us. And it's getting frustrating out there. And some people are going to have to look at Orange County, LA County are not in the cards for me. Either I can work to increase my income where it is, or I can look to where my income supports homeownership. And I think homeownership is that important. I think it is more important than living where you grew up. And I don't say that lightly. Family is really important. Being around your friends is really important. But homeownership to your financial health and wealth and well-being in the long run is important enough that if you have to move somewhere else, it is worth doing.
No, I mean, yeah. Again, this could be. We could do a whole discussion on the idea that, the affordability and the future of what people do, and the gap widening between, the wealthy and the less wealthy, especially in the environment that we're in now. We've talked about it, right? The people that thrived during the pandemic were the people that owned equities, right? The people that owned stocks, because the stock market went nuts. The people that owned houses, the housing prices went nuts. And the people that got affected the most were those that worked lower, entry level jobs, a lot of the service industry, in fast food and that sort of thing. Like, a lot of these places were affected. And yeah, there's a huge gap there. I don't know how to solve it. You and I have talked about it, and people talk, well, you build more houses. Okay, that I understand that, but you can't build them at a rate fast enough to accomplish what we're talking about here. And the same thing is, okay, you find modular or mobile or whatever it is, and you put them out in different areas and have people move there. Again, an option, but that's not going to necessarily solve the problem. I don't know what solves the problem. It is. I mean, there's a problem there. I don't know what the answer is. And unfortunately, it's not something that can be solved quickly, and it's not going to be solved ever. It's not. I mean, you've always had this. There's always been a gap. Unfortunately, it's getting wider. I don't know how you bring it closer together. So, and the same can be said for the homeless, right? I mean, we have a huge homeless population here in Southern California. That is a problem as well. How do you house? I mean, there's so many different layers to the housing issue, and it's not easily solvable. So, anyway, we could go deep on that one, and I could tell you I don't have the answers for you. All right, so let's see. So Joseph Rose says, I live in California. If I buy a property in Las Vegas as a vacation home in cash, do I have to pay other taxes on the property other than property taxes? Josh.
The only thing that could become an issue, and this really is a tax preparer question. Jeb and I know a lot. We don't know everything. You're going to pay property taxes that will go to the state of Nevada and the local municipality there. You may have to file a Nevada income tax return
You do.
for
Yeah,
the
I'm pretty
income that
sure.
you generate
Yeah.
there. So check with the tax expert that is familiar with Nevada and your California tax laws and can advise you on that. But I think you're going to end up filing an out-of-state tax return for the income that you're generating there as well.
Yeah, I did. I mean, when I owned out-of-state investment property, I had to file tax returns in those states for the income that was produced and the depreciation and all of that different stuff that was associated with that property. So my guess is yes. It just depends on whether or not you'll actually have any taxes based on how what your actual cash flow and gain with depreciation, all that good stuff is. Josh, are you willing to say who the lender is that screwed up the VA person? Are we going there?
If you do a Google search for VA home loan, they will pop up #1 in the list. And if you click it, they'll tell you how they've done more loans for more veterans, and veterans love them because apparently they believe veterans like high rates, high fees, low service, and overlays that restrict the loan far more than the VA ever intended.
All right. Symbiosis. What's your opinion of the IMF warning of a 14% downside risk to the housing market in developed economies? Familiar with this, Josh?
No, but I
Nor am I.
don't take much stock of anything that the IMF thinks. They're a global think tank that likes to run numbers from a distance. Again, tell me how it happens. Tell me how we go from massive demand and a monstrous demographic wave coming into home buying age, and a utter lack of supply. So we've talked about it. The only plausible explanation would be rates shooting to the moon. So if you believe that that can happen, you also should prepare for Armageddon, because if it did, I'm not saying that it couldn't, if it did, you would also have the United States government default on their debt. So when Obama came into office, there was less than $7 trillion of federal debt. By the time Biden leaves office, there's going to be $30 trillion. So
Probably
more than a 4x multiple. So see, he can't even afford to keep the lights on anymore because we have so much federal debt. So we've got more than 4 times the debt in the last 14, 16 years. And our debt service has barely budged because the government has manipulated and kept rates at an extremely low level. So if you have 4x the debt and you go and say, let's just say, if you thought a normal mortgage rate is 5%, that gives us a US Treasury of about 3.7%. So it's more than double where we're at. So we just doubled the debt service. And if you look, the majority of the funding was not done in 10 and 30-year treasuries. It was at the short end of the curve, things that do roll over in 2, 3, 5 years. The government can't have rates higher. So, unless you believe, well, we're sitting here saying there's a shortage of workers, we're having to raise wages, and so now all these people making more money are just going to suddenly not buy homes, and home values would drop. A thing that we always point to, prior to 2008, the housing bulls who said housing is awesome, will never go down. They pointed out that on a nationwide level, this is a pointless fact. It was a true and accurate fact, but pointless. On a nationwide level, home prices never dropped. And they said that's proof that home prices are sticky to the upside. So they were wrong, because we had already seen it in California, 3 or 4 cycles of boom and bust, but with a very predictable long-term uptrend. So where I'm going with that, there's a reason why home prices are sticky to the upside. When home prices level or drop, people do not sell unless they absolutely have to sell. So a good forced sale is your employer moves you from California to New York and they offer to pay your closing costs and eat the loss, so you sell regardless. A bad forced sale is, I lost my job, I can't afford this, I have to sell. So unless you see a monstrous amount of those, like we saw in 2008, due to horrific underwriting of loans and record low levels of equity for recent purchasers because they had put no money down in those homes, there's just not a recipe for that. At some point, we are going to see a 10, 15, 20% correction. It's further down the line than where we're at right now. So I don't ever want anyone to think that, hey, home values only go up and you can always buy and it's always going to be safe. So a 14% from the IMF, I don't care what the IMF says. There's much better economists that track and watch this stuff in the United States. And, 14%, is that plausible downside? Yeah, but it's not coming soon. If you tell me that it's in 3 years, in 5 years, in 7 years, I'm all ears and I'm all eyes for what's on the horizon that could cause that. But in the short run, the next 12 months, I am quite confident home values are going to be higher next year than they are right now.
No, agreed. Let's see here. Rum Raven. We're going to just go with Rum Raven. I like it.
The Raven just chewing down the rum, going crazy.
Just likes the rum. Anyway, maybe they're a pirate. Is this the pinnacle time and situation regarding getting the most money if you're selling a single family home in Massachusetts? It's hard to say, right? I don't think so. I think the spring of 2020 is going to be a hot time in the market. Personally, I just think you're going to see less and less inventory as you move through the end of the year, typical of a the seasonal effect with regards to real estate. I think interest rates are going to stay, fairly low, reasonable where they are now. I don't think you're going to see much movement in either direction. And I think you're going to have a lot of buyers still sitting out there, right? I mean, the holidays are about to come. Winter's about to come for a lot of people. All of those people that were thinking about moving are about to be back in their houses, looking at the same walls they did for however many months during the pandemic, still thinking about that move. And I think if the right property comes on the market, you're going to see more and more people go that direction. So I can't say what's going to happen in Massachusetts. Don't know it well enough. But I do think you're going to see, a hotter market next year. Not necessarily hotter than this past year, but hotter than what you're seeing maybe at the moment. So, all right. Josh, well, I can answer either way. Will condos appreciate as much as a single family home, Josh?
So in general, over time, they do, but they're not going to move at the same rate. I think we talked about this last week or the week before. Generally, they go up in value later than homes. As homes become less affordable, people will get pushed down. And we see in the comment section here every week, hey, prices on homes got too much. I just decided I went and bought a condo. So as you see more people getting pushed to condos, later in the cycle, condos will appreciate even more. Now, on the flip side, when an inevitable correction comes 3, 5, 7 years from now, condos will generally perform worse than single families. But if you look at them, the trend over time, they're going to appreciate very similarly.
All right. I agree with you on that clearly. I'm a little bummed. Nightbot just deleted a comment from webcams-chat.com/hotgirls. And I'm, I'm sorry, and boys video chat. So I missed a key piece there. Thank you, Nightbot, for taking care of that. We don't want to see that. Appreciate you. Anyway,
I'm pretty sure if you clicked, you wouldn't get to see hot girls or chat with them.
I'm pretty sure, but hey, they follow us, and that's all that really matters, right, Josh? Maddie's saying happy Wednesday, team. Waiting on an offer to come in tonight, as well as an agent showing as we speak. May finally get this condo sold. I've seen the market pick up. I wouldn't say considerably. I've seen the market pick up quite a bit in the last 2 weeks. So I wouldn't be surprised at all if you started getting more activity. Because I'm sure you changed those pictures that we talked about and everything is looking good.
That's why the offers are coming in. But hey, Jeb, how about this? Maddie shows up here every week and asks questions and contributes to my 805 fund. But we've never asked the question. We're talking about sell and do what? Maddie, what are you doing once you sell? You buying a house? You moving out of the state? What's going on?
Going to Vegas, baby.
Take it, see if you can double it.
Take it and run. Jennifer also gave us a $10 super chat. This mod is sticking here. Thanks for the shout out. 805 each. So thank you, Jennifer, for being here. As always, we appreciate you. Let's see here. If you're watching right now, you haven't already, hit the thumbs up. We're at 85 little thumbs. We're trying to get to like 5,000. Is that absurd? It might be. Anyway, let's see.
So here's a good one, Jeb.
All right.
Now, I'm not going to butcher this person's name. So Mr. or Mrs. Nguyen says they were
It's
thinking.
Tui Trang Nguyen.
Okay, see, you have more Westminster clients than I do because I was not prepared for that. I was thinking of renovating my home. Does it increase in tax right away or when I sell the house? So this answer depends on where you are at. Are you in California? Are you outside of California? So California with Prop 13, if you do not add on to your property or add a pool or something of
like
that
a
sort,
capital improvement type thing.
yeah, then they're not going to reassess you. So if you redo the entire interior house, you have a 4-bedroom, 2-bath house, and it gets an amazing kitchen and 2 awesome new bathrooms. Obviously, it increased the value of your home, but it doesn't result in you being taxed at a higher rate. And if you're outside of California, they're going to reassess you every year, and they're not necessarily looking at your property other than, again, if you added something to the property that increased its value in terms of a capital improvement, square footage, pool, then they could give you a higher rate. Otherwise, they're just going to look and go, oh, it was a 4-bedroom, 2-bath last year. It's a 4-bedroom, 2-bath this year. What value does that add to the assessment?
No, absolutely. If you do, like, for example, if you did an improvement on the exterior of your property, like you added a block wall or something that required a building permit, then chances are there's going to be some small assessment to your property value, but it's rather insignificant in my opinion. If you did an ADU or something like that on your property and you went and got building permits, chances are your property taxes are going to go up because there's improvements made there. But if you remodel your bathrooms, your kitchens, that sort of thing, like Josh said, nothing to.
But even remember that it's funny. It was a short and relatively easy question, but it leads to a longer discussion. In California, our primary, your assessment, they'll show you structure value, land value, and the land is worth a lot more than the structure. So even if you go and add on a master bed and bath to your home, it won't kill you as much as you think on your assessments. Jeb and I have a mutual client that their parents inherited a home in Rossmore, and it was a little house, and they completely rebuilt it and put a really big, beautiful new house. And the reassessment was at a much, much lower level than I expected. But again, when you look at the prior assessment and the current assessment, it's because so much of that value is in the land, that the beautiful new structure they put on the property didn't, just monstrously increase their taxes.
No, good stuff. Good stuff. I'm going to hit this question here just because it's right here in front of me, and I feel like it's one for you, good one for people to answer, or good one for people to hear, easy one for you to answer. How many years tax return is needed to apply for a mortgage loan? Okay, let's just go with the first part of that question. How many years tax return is needed to apply for a mortgage loan?
It's a trick question. For a lot of clients, maybe the majority of clients, tax returns are not needed. If you're have a simple salaried job, you're a school teacher, we're just going to need your W-2 and your pay stub. Now, if you have a side business that we need to include that income, or we have a Schedule C or a corporate tax return, now we need tax returns. You have a rental property, now we need tax returns. If we're looking at an FHA or a VA or a USDA loan, we're going to need 2 years. If we're looking at a conventional loan, it's going to come down to the automated underwriting system. So Fannie Mae's automated underwriting system will tell you either 1 or 2 years when we run it through. And when we're looking at Freddie Mac, it doesn't come down to the automated underwriting system. They have a hard and fast rule. If your business has been in existence for more than 5 years, so in this instance, we need the tax return because of the business. If the business has been in existence for more than 5 years, you only need 1 year tax return. If it's less than 5 years, you need 2. And I guess I should throw in there that if you have variable income like commission or bonuses, that will trigger the 2 years tax return. So if we need the 2 years, if we need the tax return and you have that variable income, we're going to need 2 years of it.
All right, there you go. Good stuff. Let me see. All right, just trying to. Here was one that was, again, pretty easy. Question. Roxana says, hi guys, typically how long does it take for a lender to tell us if we're pre-approved for a home loan? She's in Northern California. So Josh, you have a conversation with somebody today. How long is it taking you to get them approved?
It should be 24 hours or less. So the conversation is the first part. So we get your questions answered, get the basic lay of the land of what you're trying to do and what your situation is. We send out the portal request for your supporting documentation, your application. From the time we get that, unless there's something really strange or difficult or complex in there that we need to do some more research, typically within 24 hours. Worst case would be like 72 hours. And whoever you're talking to should be setting that expectation. I don't know, maybe they're spectacularly busy. Maybe they don't have a lot of bandwidth. They don't have a team that they're working with. They might tell you it's 48 hours or 72 hours. It shouldn't be a long period of time. I had a client tell me yesterday that they went through the pre-approval process with someone 10 days ago, and they were told it would take about 2 weeks. So in 4 to 5 days, they're hoping to have their pre-approval complete. Now, I'm not saying that there's never a situation where it could take that much time, but we should be able to give you a reason. Hey, you have complex income here. I want to get a written verification of employment from your employer. That can take a day or two. It could take a week if your employer doesn't get it back to us. But there can be additional things. There can be a little back and forth. Hey, now that I'm looking at all your paperwork, this is a little bit more in depth. I would like this and this. So then you have to provide that, and we review it. But for the most part, simple, straightforward files with employed borrowers, not self-employed, where we're not getting deep into tax returns, it should be 24 hours. It's really not that difficult to complete the pre-approval.
No, agreed. I'm just going through some questions here, so I am paying attention to those of you watching the camera. Just let's see here. Samuel has a question. What do you guys think about California housing market being affected by the drought? I don't really see much of an effect there. You might have people moving out of the state just because they're tired of dealing with the same problems that we see every single year, right? You have fires every year. You have droughts every year. You have, a majority running the state, which is there's tax issues. I mean, so you've got some issues within the state, clearly, outside of the political things, you have real issues, right? Fires and droughts and that sort of thing. Do people move out of state for that? Absolutely. But I wouldn't say that you're seeing an exodus because of that. For every person that moves out, you've got somebody buying that house that they're selling. So those houses aren't sitting on the market just with no offer. So I see very little effect there. But do you believe there can be a mass migration due to it? And I think that's what I just answered. No, I don't think so. I don't think you're going to see. I mean, let's be honest. California's got a lot of screwed up things going on. I mean, we vote on something. We've talked about this. We vote on something one year, and every 2 years we see the same thing come up on the ballot. It's reworded, but it's the same thing. We're voting on it again because it continues to come up and up and up. You got people leaving the state for tax reasons. You got a lot of problems within the state for sure. But with that said, there's a lot of cool things living in Southern California, that you have access to, outside of the weather, right? The fact that, geographically, we got beaches. I'm 5 minutes from the beach. I'm an hour and a half, 2 hours from the mountains. There's a lot to do. I mean, there's so many different things that play into why you live where you live. And there are people moving to California every single day. So the net migration, of people exiting California and with the people coming in is low, right? Everybody wants to use that, right? Everybody's leaving California. Okay. But how many people are coming back into the state? I've had 3 people that I know personally that have purchased out of state that have come back because they said, you know what, it sucked. Like a buddy of mine bought a house in Austin, Texas 2 years ago. Within 6 months of him buying that house, he was back here. He said it sucked out there. He goes, it was hotter than I ever thought it would be. And it was also colder than I ever thought it would be. And he was raised in Michigan. He said it was awful. And so he's back. So you're going to have people that think, hey, the grass is greener, but it's not going to change much with regards to housing prices if that's what people are looking for.
So, Jeb, think about this. I've done this myself, but if we said, hey, in the comment section, list all of the reasons why California sucks and someone would want to leave. Mentally, I've done that, and it's a long list. And then you start going, What's the list of all the things that are awesome about California that can't be replicated somewhere else? And you've literally heard our liberal overlords here in California say this, like, where are they going to go? They're not going to leave. So we can destroy the state, overtax them, abuse them in a million different ways, and where are they going to go? It's a tough call. Where are you going to go that you can get what we have? I mean, there's other amazing places to live. It's hard to find somewhere that has the balance. So again, one of the wonderful housing crash YouTube channels here, he loves to talk about migration out of California, never talks about net migration, which net migration is the only thing that matters. You know, if we lose 1,000 people in a year, it doesn't matter, but it sounds really good when you say 100,000 people left. Well, 100,000 left, 99,000 moved in. We lost 1,000 people. But specific to this question, Jeff,
Good.
the thing that yeah, good, go. the thing that I would say is that I know and have heard from clients that lived in high fire risk. So the drought leads to higher fire risk. In some of these high fire areas, they're like, this sucks, I'm getting out of here. But generally they stay in the state. So they migrate, but they stay in the state. What I would also say is if the drought continues and it really impacts farming in the Central Valley, we had some questions about, you know, Modesto, Fresno, Visalia, Tulare, that whole Central Valley. The jobs largely depend on farming throughout that area or agriculture in one way or another. It could impact their market, you know, just in terms of lower incomes. It could impact home prices. And that's why we talk about, you know, if that happened, it's not going to make an ounce of difference to our Orange County home prices, but it'll make big difference to them in the Central Valley. So I don't think it's anything that would be statewide, but there could be pockets impacted by it, but it's unlikely.
There you go. And I'm running through comments here, and I just happened to see this. That's not spelled right. There's no H in Raleigh.
Ask him
How do
how
I
to
know
spell
that?
Kinston. Ask him how to spell Kinston.
Hey, man, he'll put a G in it, bro. It actually used to be Kingston a long time ago. It was changed. I'm from North Carolina. That's why I'm bagging on it. Anyway, let's
You
move
guys,
on.
you guys couldn't pronounce the G, so you just changed it to Kinston.
Hey, man, we were tired of being recognized as Jamaicans, so we changed it.
Gotcha.
Question. Run Jim says, if paranoid about wiring funds for closing, is it crazy to wire a small amount first, then remainder after confirmed? Guess you could. I would tell you more. The most important thing to do there is when you're wiring large wiring any amount of funds, call the company that you're wiring it to and confirm that you have accurate information. Confirm the routing number, confirm the accounting number. Wire fraud is real. I've seen it happen, you know, personally with not my clients, but agents in my office clients. A guy I used to share an office with years ago. His client wired $800,000 to the wrong. It was a fraud deal. You know, he had gotten documentation from escrow, said, hey, this is the where you wire it to. And at the close of escrow, he got an email after his docs were signed saying, hey, we've changed things, wire it to this account. He didn't think anything of it, wired it to that account. It was gone. Went to the FBI. It was done through Wells Fargo. Basically, he ended up getting his money back, but it was a process to do it. But more importantly, instead of wiring small amounts, just call and verify the information, and I think you'll be good. But just more importantly, don't wire money based off a change in an email. Have a conversation with somebody at the office that you're wiring the money to.
And just like it's not paranoia if they're truly out to get you,
Yeah.
there truly are people full-time fishing, trying
absolutely.
to steal wires. It is legit. It is real. So it's not even paranoia. And Jeb
Nope.
was 100% correct. Call before you send any wire and get them on the phone. Don't email, don't text, don't do anything that can be intercepted. Call, get the right person on the phone, and get the information before you send the wire.
Yeah, and many companies, what I see this day is don't include part of the account number, or they don't include something on there so that you physically have to call to get that information in order to wire it, which is honestly probably the best method. So we will move on here. So yeah, I don't know how to go with that one. Will SB9 help or worsen the market? I think it will make it worse because now those big cash corporate buyers will be able to offer high cash amount and build ADU for more rental homes. I don't think it's going to help the market. How's that? I think the people that are going to benefit the most from SB9 are those that own property with bigger lots. It's not going to help first-time home buyers, in my opinion. That's really it. I mean, it's really simple. It's not, in my opinion, not going to do what it's intended. It's not going to make housing more affordable. So I think that's the easy answer. Jenna Ziz 32 says, "Hi, Jed Smith. So my entire life growing up, I was called Jed. So, hey, I just go with it these days. People call me, I get called Jeff, Jim, Jev, Jeb. I mean, you say it, I've heard it. So whatever you say, I respond to it. Anyway, I'm going through closing on my home. What are the protocols on builders extending my contract 3 times and not being notified after 2 weeks late? Is it time to move on?" Hard to say. If you're in contract with a builder and they're extending your contract and they're not raising the price or doing anything along those lines, it might be worth sticking it out if you can find when you're going to close, because you're going to have likely more equity in that property than when you initially signed the contract. Now, on the other hand, if they're continuing to jack up the price every time they do it, then maybe you should move on. It's a difficult question to answer without knowing all the details. But if they're a reputable builder, you can see that they're building houses, you can go in and talk to somebody. Maybe that's what you should do. But I would say if your price isn't changing, could be worth sticking it out, but continue to look and see if there's a better opportunity for you. All right, Josh, let's go with this. I'm going to ask you the question. What are your thoughts on putting an offer on a house that has tenants living in it? The seller says whoever buys it must give tenants 30 days notice after closing. In this environment, would you buy a property that has tenants in it? I mean, just at that, would you buy a property that has tenants in it?
I'd have to really like the property. Let's just say there's enough potential headaches, hassles, problems that I would have to really like the property. I mean, the reality is, I'll bet you 90% plus of these situations resolve themselves just fine. But the 2%, 5%, 10% that don't are such an aggravation. It's just probably not something I would want to get into. Now, if you told me it was a super unique property that I was getting a great price on, I might be willing to put up with some bullshit. But for the most part, I'm going to say no.
Yeah, I would say no too. I mean, in the environment that we're in now with the eviction moratorium, I mean, even though that a lot of states don't have that in place, it's just a pain to deal with tenants, especially if they give you any issue. I mean, the fact is, if they do give you any issue, even without the moratorium in place, it's going to take months to get them out and deal with that. Now, if you're buying it as an investment property and you're planning on renting it out anyway, that's a different story, because if you can get some estoppels or something showing that proof that they've paid their payments over a period of time, you can get ask them for updated information to make sure they're qualified tenants to live there. A little bit different situation. But if you're living in it as your primary residence, I wouldn't personally go with it, unless, like Josh said, there's something. There's some motivation, real motivation there to get you to do that. But yeah, Josh, you're gonna say something?
No, I was ready to move on. I got a trick question. You ready for a trick question?
Yeah.
Cloud9 says, do y'all have people y'all know in Central Florida? You want to know why it's a trick question?
Yeah.
We got people everywhere. We got people everywhere. Don't limit it to one area. We got people everywhere. So
yeah. But Central Florida, huh? What are we saying Central Florida? Is that Tampa? Is that like Tampa?
That's Central Gulf Coast, and then you got the Central Atlantic Coast. I don't know what's over there.
I'm just guessing, but the answer is yeah. If you need a real estate agent or a mortgage professional, we can guide you in the right direction if that's the question to that. If the question is, do you just know people in Central Florida? The answer is yes to that too.
If you're looking for friends and stuff, we can connect you with people out there too.
Anyway, there we go.
So I'm going to throw the trick up there. So if you need someone, there's Jeb's email, there's my email. If you just have a question that you don't want to ask here on the show, some things are personal or private. You want to throw that out there. We get a bunch of emails throughout the week. Jeb's really good about getting back to people. I get back to people. So anything you want or need, just let us know.
Yeah, absolutely. Hot dog 313, looks to be a veteran here, which we're going to veteran. Did I see that somewhere? Did I see veteran VA loan? Military move. Yeah. New to the stream here, guys. Was watching you, Jeb, earlier today. So YouTube recommended this, thankfully. So anyway, moving in 6 months to Hawaii, military move. I've lived there before and know the area and would love to buy. I know any mistakes in real estate are only amplified in Hawaii with a $500,000 house. This is my first purchase. We'll be using a VA loan. Is this summer dangerous? I don't know that it's dangerous. Like a lot of places, Hawaii has a supply issue, probably more so than, here in the U.S. because, a lot of Hawaii is built out, right? They're not doing probably a lot of new construction on the island of Hawaii, just because a lot of what isn't built now is land that you probably can't build on for multiple reasons. And with that said, the cost to get material there and everything else is a problem, right? I mean, because you're having to ship it across the ocean and all that good stuff. So I wouldn't say that, it would be any more dangerous than any other summer. I think it's like any other housing market, finding the right property, being comfortable with the payment, being comfortable with, the timeline, how long you're going to be there. You being in the military, is this a short-term thing? Are you only going to be there for 2 years and have to sell? Those are things that you need to consider, right? With the military and relocation, things can happen anytime, and you just need to know that, okay, if I get moved, am I in a position to keep this property and rent it out? What does that look like for you? VA loans are great loans. There's a lot of benefits there, but it's not, it doesn't come without considering all of these other things too. Josh, and thank you for your service. Yeah, go ahead.
Absolutely. The big one with the VA loan in a short time frame is VA has the option of putting no money down. So if you buy and you put no money down and you have to sell, you got to pay realtors, you got to pay closing costs. So you're actually upside down the moment you buy with it. So it is an amazing loan program. So don't take away from that I'm saying it's bad. It's just something you have to be aware of. And if you don't have a service-related disability, you're also going to pay a funding fee. So you're going to add another 2-point-something% on top of that if you don't put a down payment and it's your first time use, which in this situation it is. So you're actually 6 to 7 to 8% upside down the minute you get in the door. So again, we do expect home prices to continue going up. You're going to be amortizing that loan down. Payment is going to be a great interest rate. You're not going to have mortgage insurance, but you just want to take those things into account. Hawaii to me is crazy, just like I'm sure other parts of the country look at California and go, that's nuts, because I look and I'm like, why is that house so expensive? Well, because it's on a little island. They had to take all the supplies out there, and it's a little island. There's not a lot of land. So it's a weird and unique market. So I would absolutely say make sure you're connecting with a top tier realtor and put that at the top of your priority list. A lender is always important, but in that market, your realtor is going to be even more important.
Good stuff. Good stuff. Let's see here. I got two questions that I want to throw up here. Let's see here. First one, in your opinion, is there enough landlords done with tenants and toilets that will sell their properties when the eviction moratorium endangered? Basically, when it's up. I don't think so. I mean, you're going to have some, of course, that want to sell it. Even with these properties that are tenant or landlord owned investment properties, even with tenants not paying a mortgage for 18 months or whatever it is, chances are once you factor in the equity gained on that property over that period of time, most of these landlords are still ahead. Now, it doesn't make it right. I don't think it's right by any means. A lot of them got screwed in how this played out, but I think a lot of them see a situation, right? So if they sell that investment property, what do? Do they pay capital gains on that? right? Because now it's income. Do they pay capital gains, or do they roll it into another investment property? And if they roll it into another investment property, they're essentially putting themselves in the exact same position to some extent, right? So, the lesser of two evils, which, you probably go with what you know versus what you don't know in many cases. And you probably work to find better tenants that next time, right? You do better background checks. You do, more diligent credit checks and that sort of thing. Clearly, there's going to be some people that say, screw it, I'm out. But I don't think that's going to be the case, because when you're an investor, there's a risk associated with that going into it. Many people never see the risk because things move smoothly. We're in an environment right now where things weren't so smooth, but I just don't know. I think there's big repercussions for selling all that property and having to pay different taxes and that sort of thing along with it. And I don't think that's worth the getting rid of it. Josh, here you own some property. Fortunately, your tenants paid, but what are your thoughts on that question?
I have had no problems, which I'm fortunate because I know people out there that have had problems. But in my personal sphere of other landlords, people that invest in real estate, I so even we didn't close the loan. The borrower signed docs yesterday. Gentleman's retired. He owns his own home and he has two rentals. One of his rentals, his tenant has not paid since January of last year. His focus is not figuring out how he can sell his property. His focus is figuring out how he can get that person out of there and get someone actually paying the rents in there. And no, it's not that he's heartless. It's that any rational person would realize that after 18 months of this, you are milking the system and not in need of assistance or help. You should have been able to figure this out by now with no housing costs for 18 months. And in California, everywhere, the federal government has made money available to the states to help both tenants and landlords. So this just gives you the mindset of a lot of the people who are under those eviction moratoriums. He didn't want to do the work on his part to complete the application to help this guy get some of the funds from the state, even though they're available. So everything's anecdotal and it's just a one-off case. But in his instance, no, he just wants to get the guy out of there and start collecting rent again. He's not thinking of selling. Now, if maybe he had a bigger loan and he was having to feed even more money to it every month, it would be a different story. So it's like everything else. We talk about forbearance. How many people are going to end up selling their home? As a percentage, not many, but there's going to be plenty of them. So there will be landlords who just throw in the towel. And like for my entire career of being in real estate, a phenomenon I've been aware of, that investors get to a certain point and they go, you know what, I can sell these and just cash in my chips and not be a landlord anymore. Not all investors, but a lot of them, a significant percentage. They hit 75, 80 and they're like, I got enough equity. I don't need to deal with tenant headaches. So that's a naturally occurring thing, and this could absolutely exacerbate that and have more people put it on the market. But again, it's a drip. It's a drop in the ocean. It's not going to be an impact to the market right now, just because the supply is so limited.
Good stuff. Evelyn's asking, do we deal with the city of Indio? Ask your question. I mean, Josh has a house out in the desert. I know several people that have houses out in Indio. We might be able to answer the question. Not sure exactly, but put it in there. We'll see if we can address it. Here's a good question. We haven't gotten this one before, Josh, and quite frankly, I'm sitting here trying to think of how to address this. But what mistakes did either of you make when purchasing your first property, and what would you have done differently looking back? This is deep, bro. This is deep.
So, like no one, especially we flash back 30 minutes and the people ready to throw in the towel and wondering how younger people are ever going to be able to buy a home. I almost don't want to tell my story. So my first place was a condo here in Huntington Beach, bitchin' condo. It was beat. It was terrible, but the location was awesome. We were literally one block to the ocean. You could hear the waves at night, and in the morning you would hear surfers' little feet start going by at about 5 o'clock in the morning. So super cool. So from that perspective, we put 10% down. Seller carried the loan at a below market interest rate with no mortgage insurance. We took a little bit of our extra money, did a full renovation. So our gross condo was a nice little condo. Everything worked out really well for us. So looking back, could we have done something different? Like the only thing that I would have liked to have done differently before we bought that, I wanted to buy units using an FHA loan and then keep those as a rental when we moved out. Never did that. So the Bitchin' House condo that we were able to get was awesome, and we loved it. We still have fond memories of it, even though I don't own it anymore. But other than not getting units first with an FHA loan, I can't think of anything. How about you, Jeb?
So first property purchased in Mission Viejo, 2004. And the mistake was, well, there's a couple here. The first one was buying in an area that you didn't really want to be just because you could get more house. So at that time, I lived in Huntington Beach, got married, and you could buy way more property in South County than you could here. So bought a big house over 3,000 square feet. Just over $1 million at the time. It was $1,079,000. And
is that like $9 million today? $1 million house in 2004?
I don't know. It was in Pacific Hills in Mission Viejo. Had a nice view, did the whole thing. But the problem was every time we would go out, we would come north, right? We would be in Huntington Beach or Newport Beach or somewhere up here, Costa Mesa, somewhere north. So you always had to travel. My office at the time was in Costa Mesa and right South Coast Metro, and the traffic sucked. I mean, it was miserable every day driving home. And so the location, I tell people all the time, buy where you want to live, right? Even if you have to sacrifice something else, live where you want to live, because otherwise it's going to be miserable going home. Don't be miserable going home every day. And that's what it was. It sucked. And so that's probably the biggest mistake. The second mistake that goes along with that is putting in a swimming pool about finishing it, the swimming pool, the barbecue, the outdoor hardscape space about 2 weeks before putting the house on the market, because it decided once it was done, that didn't really correct the issues either. And so the house was put on the market.
You got all of the money for the pool and the outdoor kitchen, everything out, right? You got dollar for dollar. You got it all back out.
Yeah, no, there was a profit on the house, but we probably lost quite a bit by doing the pool at the end there without really, taking much into consideration. So there was a couple of different mistakes down there, and I've made a lot of mistakes in different areas of owning real estate. I've sold property that shouldn't have been sold, that would now be worth way more than it was than I ever even thought, just because at that time I just, I was young. I was immature. Didn't understand a lot of the fundamentals and a lot of that stuff. So it could be a video in itself, but I'll save you from that at the moment. But live where you want to live. That's what I have to take. My advice from going over that at the moment. So anyway, here we go. Let's see. What do you see? For a link. Michael DeRee. Josh, is there a difference in getting a 15-year loan versus a 30-year loan and paying it off in 15 years?
It's a big difference. It's going to be about about 0.5% in interest. So the 15-year loan will require less in payments due to the lower interest rate. Now, in return for that, you are locking yourself into that 15-year payment. And people historically thought, well, do the 15-year because it cuts all that interest off by taking it down to 15 years. Well, that was when interest rates were 7.5%, 8.5%, 9.5%. So when I started in 95 doing home loans, rates were about 9%, and your 15-year was about 7%, or 7.5%. So you were getting a big savings in interest, but more importantly, since the amount that went to interest in the early years was so high, those additional principal payments rapidly brought it down. So long way of saying you are only seeing about a 20% increase in the payment to make a 50% reduction in the term of the loan. So it was sort of no brainer. Now with interest rates so low, you're seeing about a 50% increase in the monthly payment to make a 50% reduction in the term of the loan. So for most people, although it's enticing to look at that shorter term, I don't necessarily say go take a 15 instead of a 30 when you buy. The most of the 15s we do are for people that are 10 years into their loan. So instead of looking at doing a 20-year or a 30-year, we can keep them in a similar or better payment by putting them into a 15. For people who are comparing the options of a 30, if we're refinancing a 2-year-old loan and there's 28 years left to go, or if they're buying a house and we're looking at 30 and they say I can afford a 15 and we can qualify them for a 15, my advice would generally be take the longer term loan and make the commitment to yourself that you're going to make additional principal payments. Jeb, I think you do this, and I do that. I refinanced my own loan last year, and we could have saved a bunch of money and a bunch of interest on the 15-year. And I just sat back and said, well, what would it cost to pay it off in 20 years? And I put that additional amount in principal towards the payment every month. So that way, if something happens, something goes crazy, medical expense, emergency, just don't feel like it, I don't have to make that payment. So really, the only people I recommend the 15-year for, this is one of my favorite examples. I've got a client up north. The guy makes $350,000 a year. It does not matter. Every time we go to refinance his loan, he's got $200,000 of consumer debt. So he kept wanting to pay it off with a cash out loan, pay it off with a cash out loan. Finally, we just said, we're not paying anything off. We're putting you into a 15-year loan. So that will slow your spending and you'll get this thing paid off. So if you're not disciplined enough to make the additional payment, maybe the 15-year makes sense. But for most people who can do it, I'd say take the 30.
No, I mean, what you said there, I mean, yeah, I pay additional every month towards the mortgage just to, I mean, to make a bigger impact, right? I mean, we talked about it the other day. Does it make sense to pay off your mortgage, right? I mean, I'm 41 years old. I'd like to not have a mortgage, but paying off my mortgage today with the interest rate where it is, it really makes no sense. I mean, I that money is better invested in something with a higher return than what I'm spending every single month. But again, like you said, you got to have the discipline to be able to do that. If you're just spending the money anyway, then it should go, towards the mortgage. But if you're actually saving it and putting it into something to make more money, then having a mortgage payment really, I mean, isn't that big of a deal, in my opinion. Clearly, I disagree with Dave Ramsey here because he would tell you exactly the opposite. Let's see. Josh, this is a question. We didn't answer this directly earlier, but something similar. First-time buyer, should I buy a house or a condo first? And
Units.
let's just ignore the South Florida.
We just answered that. We said units. Buy units first.
Yes. Yeah, I know. Excuse me. I think, it depends, right? I mean, each person, some people don't want a house because they don't want the maintenance associated with it. They don't want the cost associated with it, right? When the roof goes bad, the paint on the exterior needs to be painted. They don't want to deal with that. And so therefore you're probably a condo person. They don't want the maintenance of a yard, so on and so forth. Then you have the opposite, people that say, I have to have the yard. I've got kids, I've got a dog, I've got whatever. I can't live in like, people joining walls. So it depends on where you are in your life and what you're okay with. As we said earlier, single families tend to appreciate a little bit faster than condos, especially in the environment, where there's I guess in a normal market they would. Right now, condos are appreciating a little bit faster just because they're usually more affordable. But I think it's to each his own. What's right for you in your life? Being comfortable with the payments. You have to be comfortable with a homeowners association, people telling you what you can and cannot do. Those are all things that some people just aren't okay with. Anything you want to add to that?
No, you nailed it. What I would piggyback on is just my personal experience. Told you guys my first property was a condo, loved it, wouldn't change anything about it, had a great experience. Like the example that I would use would be, I inherited my dad's condo here in Huntington Beach last year. It's worth less than half of what Jeb's, Jeb lives in an association. So it's not a condo, but saying it's worth less than half of what Jeb's is. The HOA dues are the same, within a couple bucks of each other, the same. And if you look at Jeb's complex and see the amenities they have, bitch, an Olympic pool, a couple of clubhouses. Jeb, is this now the second time they're painting the places in there since you've lived there?
Yeah.
They have new roofs. That's all on the association. They do a spectacular job of maintaining the place for a very reasonable fee. So that's the thing that I would say. People probably don't pay enough attention to the economics of the HOA and the soundness of their finances. But other than that, I'm never anti-condo if that's where you're at in your life stage and you're comfortable living there.
No, absolutely. Nothing wrong with it. Let's see. We're getting close to 152. Final questions. Yeah, go ahead.
There's a follow-up on this one. Victor R says, I'm not too familiar with the condo. Can you explain what the difference is between a single family home and a condo?
Not to remember the condo. I'm sorry, I was reading the question. Between a single family and a condo. So the difference is a condo is let's see here. How do we say this? So a condo is typically how do we explain the difference between a condo and a single family and easy to
So you
understand
don't
terms?
own the land with the condo. The
I guess
association
that's
owns the condo. So you own the airspace where your unit is, and you own the real estate that unit. But you actually own what is it? It's an
it's not a
interest.
fractional ownership because that's like a co-op. You don't share your ownership in that particular property with anyone else. You just don't own the land underneath that property. And typically in a condo, the association is responsible for everything on the outside of those walls, right? So everything on the inside of those walls is your responsibility. Everything on the outside, and in some cases, the HOA might cover the inside of the contents of those walls too. But in many cases, they don't, and you're only responsible for the interior. If something were to burn down or something happened, you're responsible for having the insurance to rebuild the interior. The exterior is being maintained by the association, right? There's a board of directors. They make decisions on behalf of the entire community on capital improvements, on dues, on maintenance, on all of that stuff. And these are people that are voted in by the community itself. So that's for the most part. Sometimes condos, the utilities, the water, the sewer, the trash is maintained by the association. That's not something separate you have to pay. Whereas in a single family home, it's your responsibility, right? The yard is your responsibility. The roof, everything with regards to that property, all the utilities are your responsibility in that case. So it's 100% you. And you own the land on that property. If you wanted to tear your house down and rebuild it or do something like that, you could do it. Assuming that you followed the building codes of the city. So
Look,
that
I'm looking over here in the comments, and the people that hate condos really hate condos. Again, I think it's more nuanced than that. Obviously, if you don't like it or it doesn't appeal to you, then it is not a good decision.
right.
But like I said, I own 2 condos. I have no problem with them. In a perfect world, I think most people would prefer a single family residence, but not everyone. 95% of people. So from that perspective, but Jeb, I think we have a good one here to kind of close and wrap up with. Rick Carrington pops up. Should I buy another property that costs more to get out of taxes? And the question, when you sell a property and have 100,000 in equity, how do you get out of the taxes? So
Well,
I'm assuming this is a rental property. If
well,
it's
yeah,
if it's your primary,
yeah, it's two ways to go here, right? If it's your primary and you've exceeded your capital gains exemption, right? That 250,000 for individual, 500,000 for joint, that there's no way to avoid the taxes that you have to pay on that property, assuming you've already done all your write-offs with regards to improvements and all that good stuff. At least that I'm aware of. Right now, this is going to be a tax question for a tax professional, not for Josh and I, when you're starting to really talk about taxes. But no way to get out of it. Now, if you own an investment property, you can do a 1031, take that in that gain, if you will, roll it into another like kind property, similar property of higher value, and you can avoid those capital gains. Is that what we were going with, Josh?
yeah,
Okay. Yeah.
yeah. And the other thing I would say, there's a common misconception. People ask this: I have $100,000 in equity. I'm going to have to pay taxes on that. You do not pay taxes on your equity. You pay taxes on the appreciation above and beyond your basis. So there's a tax basis when you purchase the property that can decrease over time if you depreciate that. So the difference between the sale price and your tax basis is what you're going to get taxed on.
No, good clarification there. All right, guys, we are towards the end of the show here. We've been on almost 2 hours. Like I always do, like to ask a favor. Guys, made the lights come on again. If you're watching now, you haven't already, hit the like button. Follow us, subscribe if you don't already. Continue to stay updated on everything real estate related. Here every Wednesday with a live. Generally post about 3 videos a week to keep you updated on everything with regards to real estate. Josh, final questions? Anything you want to get off your chest? Any
No, No, it is an interesting time. We come to the end of the year, and then all of us, you're looking at the fourth quarter, you're trying to get some stuff done. Another 6 or 8 weeks, we're all going to be transitioning into the holidays, and whether we like it or not, with holiday parties, if we get to have them this year with COVID and whatnot, you just get distracted and get kind of pulled away from things. So both business wise and personal wise, I feel a little crunch here to try and get stuff done in the next 6 or 8 weeks here before things slow down in December.
No, absolutely. It's, like you said, the end of the year is going to be here before you know it, right? And so we're going to be talking about the 2022 housing market. For those of you watching now, not a lot's going to change in the housing market over the next couple of weeks, in my opinion. I mean, you're not going to see, there's not going to be a big shift in housing. I think you're going to see less inventory, like we talked about. Buyer demand is not really going to go anywhere. I think if a good property comes on the market, you're going to have the same situation you've had over the last couple of weeks. There's going to be competition out there, at least locally, right? Real estate's local. We said that earlier. So just keep that in mind when you're out there making offers, and make sure you're working with a professional. If you need one of those, Josh and I can hook you up. There's a link kind of scrolling in that little ticker at the bottom there at the end of it. We're happy to connect you with a mortgage professional, real estate professional anywhere in the country. If it doesn't happen immediately, bear with us. Get a lot of emails and trying to connect people, but we appreciate you being here. Josh?
No, that's it, and that's all. Thanks for showing up and listening to us.
All right, guys, we appreciate you. We'll see you soon. Adios.